Vanakkam Chennai. Good afternoon to everyone. When I really thought about what topic to talk about in terms of a new idea, what I thought is why not talk about bonds and asset class. That is a missing piece in everybody's portfolio in terms of allocation, I would probably call it. Unlike a lot of the conversations that you had in the morning, a lot of MCs were there. Jiraaf, we are kind of, I would say, relatively new in this environment. We are a fixed income focus and platform which focuses on fixed income investments. We strongly believe in the aspect of fixed returns for the investors. And if you look at the SEBI regulation, it's almost like just 3 years old, right? And I strongly wanted to have a conversation about it, and I hope you can take away a few things about fixed income and bonds after this conference is over. We all know the fact that portfolio construction, it's always not about, okay, I'm going to have some sort of returns, right? It's all about the outcomes. And when we think about outcomes, there's always the angle of how much risk you're taking, how much returns you're expecting, so that balance has to be there. And all type of portfolios, if you really want to generate sustainable alpha, it's all about the diversified portfolios. I mean, whether we are talking about an equity asset class, fixed income or debt asset class, then always there's going to be precious metals or from a standpoint, real estate tied to it, right? I think of investments in the form of like 3 layers. I'm just simplifying it. I mean, we can debate about it, right? One is the growth layer, where we are thinking about equities for long term, 10 years, 20 years, and that provides us power of compounding, where dedication, discipline, commitment, all that plays into role. You're going to ride the markets, and that should be there in everybody's portfolio because you're really looking at long-term aspect of it. But I'm going to ask a question to everybody here. Do we have only long-term goals? And that's the point I want you to take away from here. We do not, right? We have short-term goals, we have medium-term goals, we have long-term goals. Every customer has got all type of goals any point in time. As we go closer and closer and we move through the years, new short-term goals, medium-term goals keep coming. And that is the reason all these asset classes do play a different type of role. And that's what, when we understand that, and obviously retail investors also try to understand that, right? And that's what is very important, that balance matters when you really think about investors' needs, goals. And they are different at different point in time. And we want to make sure the fact that fixed income, specifically when you think about bonds, play a large role in the short-term, mid-term kind of goals. And that's what we want. We want portfolios constructed for consistency, resilience, serving short-term goals and long-term goals, balancing growth for long-term with the aspect of generating or providing some protection in the shorter term. Again, I'm putting this slide not as a way to say the fact that fixed income is better than equity. So I'm very clear about it, right? I'm always in the aspect of trying to have balanced portfolios. And a lot of times I go in the market because we are all a platform, we talk to customers on a day in, day out basis, right? There's always this aspect of 2-3 myths that always exist. One is the fact is, bonds, fixed income, returns are pathetic. I can sleep over and get some returns in the equity anytime, right? But that's not the case. And if you look at last 10 years in terms of equities performance, there's going to be the volatility that's going to be there. And it is not new. I mean, everybody has seen it. So if you do look at a CAGR, it will be like somewhere around, say, 10%, 11%. A good AAA, AA rated bond, a corporate bond could probably provide you 10% as well. I'm not asking the fact that we have to move from here. But all I'm trying to say is, I want to break the myth of the fact that fixed income investments do not provide good returns, right? It can provide some competitive returns as well, which can stand on its own. And that is one of the important reasons diversification plays a large role. And again, I'm going back to the 3 layers. The growth layer, when we're looking at equity investments for long-term aspects of it. Then there's going to be the hedging and anchoring layer, where you got precious metals and other asset classes coming to play. Then I call myself a calm layer, which is where I feel fixed income really plays. And that should be part of everybody's portfolio. Whether you're looking at long-term, the allocation could be different, or short-term, medium-term, your risk appetite, whether you're a high-risk appetite customer or a conservative investor. So these allocations could change, but as a part of your portfolios, it does play a role and it provides a valuable diversification tool. And I'm going to start with this, and I'm going to ask me the fact, why is he explaining a bond? I think there is some background tied to it. The fact of the matter is, if you talk about India and Indian households, the awareness of bonds is very, very low. If you tell them, if you go ask people, do you know what a bond is? And you go them, ask them, do you know what a FD is? Do you know what a mutual fund is? Do you know what a stock is? And FDs would probably give you 90% of them, so we know what is fixed deposit. And if I go and ask them whether it's equity or mutual funds, they'll 60, 70% in the investor community will say, oh, I know about it. In the bond side, it's merely 10%. And that's the education that we are in. And that I'll tell you in the form of stats. I'm not put it on the slide. I'm using the US market, given one of the large economies, it's easier to kind of compare it, right? Fixed deposits in US is $1.6 trillion. Fixed deposits in India, it's $2.5 trillion, much higher than even US. Then the other question comes to, what is the bond size in US? It's $55 trillion. What is the size in India? It's about $2.4 trillion. And if I look at corporate bonds, about 600 billion, I would say a little over $500 billion, compared to US of $13 billion. So the point I'm trying to do is, the corporate bond market, at least in India, is not evolved. It is now started to pick up space, growing about 12% CAGR for the last, I would say, 5 years. But the point I was trying to take is the fact that it is catching up. And if you really look into Indian market, you're talking about GDP growth, we're talking about 5 trillion economy. How does 5 trillion economy going to happen? If you're not going to invest in companies in India, right? Companies need to borrow money. Companies need to invest in manufacturing, invest in employment, invest in every other particular sector. And that needs money. And that the way they're going to do it is borrowing in the form of bonds. And this sector is going to see a massive growth that would feed into the growth nature of what India is, right? And that's something that's catching up. And we strongly believe the fact that this is an asset class that is not really penetrated much. And again, I'll give you another, I would probably start. US, 20% of the allocation average households have it in bonds, which is, I would say, debt. In India, less than 2% of the people have allocation. Less than 2% in terms of allocation to debt and bonds. So people have this constant aspect of things are going to work out. Things always are going to grow. Other volatile asset classes will always continue and we can make returns. I think the point that they would probably miss in the fact that this calm layer, this layer of fixed nature in business is not actually, they think the fact that it's probably not giving returns, or I'm going to time the market and get a better return in the volatile asset classes, right? So the point, again, I'm coming back to the aspect is the diversification and how bonds play a role. And for people who don't know bond here, we know the fact is bonds are essentially an institution's lending money. As an investor, you're lending money to particularly a company or a government, an institution. With that promise, they are promising you to pay a defined return for the money that you have lent to them over a defined period of time. So in that case, what it means is your tenure of the bond is fixed, the return they are promising is fixed, at least they are promising it's fixed, and the timing of the payments, whether it is a principal, interest, all of them are also communicated before you invest in the bond. So bond is pretty much a fixed income asset class instrument that companies and institutions, even governments, do it. And the other part I would probably want to call out would be the fact that let's take the other example of the FD, right? If you look at FD, as I was talking to you, India is about $2.5 trillion of money is parked in FDs compared to, say, $1.5 trillion in US, right? And the point of the thing is, when people are really thinking about the short term, mid-term, I think the reason of short term, mid-term for them is goals. They have a goal. My son is going for education. I have a marriage that I have to take money for. I am going to down payment on my house. And everybody has that. Nobody is always thinking the fact 20 years is when I need my money, right? There's always the short term. And I frequently meet customers where they have to liquidate. And they're actually putting it, they want to liquidate it because they have to fund the short term goal. Because lot of us, when we are thinking about, right, do we worry about our long-term goals often, or we worry about short-term and medium-term goals? And that's where the main point is people not able to allocate. And when they have that thing, what they happened is, they will say, okay, I'll park my money in FDs. That is the reason FD, I'm not saying FD is it's a fantastic instrument, it plays a role. But the thing is, if it is short term, people park a lot in the FDs and stuff. If it is long term, it is going. What I'm saying is, you could, even a corporate government bond could give you a little bit extra yield than an FD. So then, if you think about government, a sovereign government, I mean, unless or until the Indian government defaults, so I think I have 100% confidence in the Indian government, right? So a AAA bond, AA rated bond could give you almost 9% tied to it, right? So all I'm saying is, just gives that ability for people to think about fixed income, and for short-term, medium, little bit over the FD, where they can kind of think about as using it as a tool to generate a little bit of alpha than FD, but not going all the way and taking risk, because you need the money at that point in time. And again, bonds, I mean, the way I would say is, bonds, very great for goal-based investing, especially short-term goals and medium-term goals, because you have timing, and that it can provide. And it can provide that aspect of, okay, no volatility comparatively to other asset classes, and it can provide that kind of diversification that you'll probably need it, right? This, again, I'm using a little bit of education here because, as I said, I'm always thinking about the 10% only people knowing about bonds. That's the reason I'm putting it. Bonds do carry risks, just like any other investments. The biggest risk that would probably think about is whether the company or the institution that is borrowing money, will they be able to pay back on time? That is called the credit risk. There is always the liquidity aspect of it. Compared to an equity market, the liquidity is not as robust as possible, but it's improving. The other one is the interest rates risk, which means that if you want to liquidate your bonds before, there's always tied to interest rates up or down, which has an inverse proportion to the bond prices that can impact your bonds, right? And this one I'm putting it so that at least that perception of how we people think about bonds happen. This is a 10-year CRISIL for a 3-year average tenure of bonds from AAA to BBB, which are investment grade bonds. And that is the default rate. 0.14% is the default rate of AAA bonds in the last 10 years on 3-year average tenure bonds. AA is 0.41, A is 0.77, and BBB, which is the extreme on the investment grade, is 1.92. That is the default rate last 10 years, 3-year average tenure. Like after BBB, with junk. So as this, it's not zero, which means that there is risk involved. The question is whether 1 or 2 instances would probably make us run away from an asset class. And bonds, you can probably reduce it even further in the form of trying to play with risk appetite. If you are very conservative, obviously you'll go for the highest credit rated. You can go government bond or AAA bonds. Or if you're really thinking about it, okay, you can also start reading the information about each and every company that provides an ability to be focused on the companies you have a lot of confidence in. Tenure plays a large role as well, because if you're really thinking about risk, the shorter the tenure, the risk relatively compared to a longer high tenure bond will be different, right? So I will not spend a lot of time here. So here is one thing which I have constructed for a customer who want money in 3 years, had a 1 crore plus corpus, but money in 3 years, but he wants an alpha more than FD. So we constructed a bond portfolio where he puts the money, we diversified across bonds, where the repayment schedules, principal and interest coming back, can align with what is monthly money he wants to get out of the corpus. So anyway, because Jiraaf is a relatively very new platform comparatively to your large AMCs, I'm just going to take time to just talk 2 minutes on this one. We are a SEBI-registered, online registered bond broker focused on fixed income investments only. And we are backed by some of the large institutions, private institutions. And we have done in the investment case debt 6,600 plus score. And we are focused on fixed income. I think that's our primary. We wanted to actually democratize debt investments. We strongly believe in India's debt market growth is the way for India's growth in multiple trillion dollar economy. And we believe this is the only way that SMEs, MSMEs, and a lot of things in India would probably flourish. And that's what we wanted to kind of do it. With that said, yeah, I mean, as the partners, we will always look at the fact that you have an ability to provide different type of bonds, AAA to BBB, investment grade plus government. Returns vary depending on the risk appetite, tenures vary. or the repayments vary. So this provides an opportunity for customers when they think about the portfolio. Again, coming back to the original conversation, a portfolio should have long-term, short-term goals. Sorry, a customer has long-term, short-term, and your
Mr.
portfolio also has to be
Jayaprakash.
diversified. Yeah. Thank you very much.